Good evening, everyone. Thank you for joining this evening's Corporate Connect featuring United Hampshire US REIT. This webinar is organized by SIAS and supported by SGX. We will kick off tonight's webinar with a presentation by Mr. Jeff Howie, market strategist from SGX on recent market highlights, followed by the corporate presentation by the senior management of United Hampshire US REIT, Mr. Robert Smith, Chief Executive Officer, and Mr. Gerard Yuan, Chief Financial Officer. Thereafter, we will end off with a Q&A session. United Hampshire US REIT is an established Singapore-listed REIT and Asia's first US grocery-anchored shopping center and self-storage REIT. Without further ado, can I invite Mr. Jeff Howie to kickstart the session?
Sure, Joyce. Hi. I'll just share the screen. Bear with me. Okay. Thank you. And I'll take a quick 10 to 15 minutes just to provide a very quick overview of where we are currently in our stock market and obviously relay some of the highlights as we usually do. But very much looking forward to hearing from Robert and the team very shortly. So I'll try not to take too much time. Just to, I guess, reiterate that we are really one of the most diversified stock markets in the world in terms of international exposure. More than 40% of the revenue that's associated with our Straits Times Index is actually reported to APAC economies outside of Singapore. And this is one reason why our Straits Times Index has been the most defensive across all the developed markets so far this year. While the STI has generated a 3% total return so far in the year to date, the tech-led S&P 500 has declined something like 15%, as has the FTSE Developed Index in Singapore dollar terms. And of course, the tech sector has been most adversely impacted by those two key drivers of inflation, that is higher energy costs and of course supply chain constraints. And that has been further impacted this year by the higher interest rates and potentially the negative impact on growth that the higher interest rates are having. At the same time, the Jakarta Composite Index has really led the emerging economy benchmark so far this year. It's up 6% in Singapore dollar terms so far, with the FTSE Emerging Index down around 13% year to date. And of course, the STI is most correlated to the FTSE ASEAN All Share Index. And as I said, regional exposure is not just a key part of the STI, but it's also a very key part of all our companies that are listed on Singapore Exchange. In fact, if you look at the three strongest STI stocks so far this year, you have Sembcorp Industries, Yangtze Jiang Shipbuilding, and Jardine Cycle and Carriage. And of course, the auto distributor Jardine Cycle and Carriage reports 90% of its revenue to Indonesia. Singapore makes up just 60% of the revenue of Sembcorp Industries. And then Yangtze Jiang Shipbuilding is, of course, based in Jiangsu. So quickly, another key driver of the STI so far is that trio of DBS, OCBC, and UOB that have averaged a 1% decline so far in total returns. APAC banks, by comparison, have declined by around 4%, and global banks have declined even more at 10%. So aside from the higher net interest income in the first quarter compared to the fourth quarter of last year, the banks did see I guess a bigger quarter-on-quarter increase in their non-interest income in the first quarter of this year on the back of wealth management and digitalization initiatives. And the ability for the long-term rates to maintain premiums to the short-term overnight swap rates will obviously support the net interest margins of the banks and thus also the net interest income. However, the net interest income also depends on the ability for the banks to grow their loan books, which is obviously kind of tied to growth outlooks as well. So that's that impact of higher interest rates on growth has been one of the main reasons why banks, albeit still one of the more defensive industries across the world so far this year, have trimmed some of their gains over the past couple of months. In terms of the sectors, for the year to date, the energy and the ag stocks, they've really led the global stock market as supply constraints, obviously from the Ukraine crisis, have exacerbated the commodity-related price gains that had been previously driven up by the demand factors of 2021. Our CPI report last week showed that our headline CPI was at 5.6% year on year. That was mainly driven in private transport costs, which were up 19% year on year. And private transport maintained something like a 12% weight in our headline CPI. But of course, it's emitted from the core CPI, and the core CPI came in at 3.6% gain for May. At the same time, electricity and gas has again seen the highest year-on-year increase. It was up 20% in May. It was also up 20% year-on-year in April. So electricity and gas, it does maintain a lesser 3% in the core CPI and 3% in the headline CPI. But looking forward, MTI did note that the MAS core inflation is forecast to pick up further in coming months before moderating towards the end of the year as some of the external inflationary pressures recede. But nonetheless, those upside risks remain. Now, what we've seen is much of this echo into the stock market in recent weeks. So amongst our most actively traded 100 stocks this year, we've got Rex, Geo Energy, RH Petrobras, and Golden Energy and Resources, with the 4 stocks averaging 38% gain so far in the year to date. Now, that's come off quite a bit over the last couple of weeks in terms of the reason why. Of course, Brent crude oil, it's currently trading at around $115 US a barrel. That's down from $125 a barrel in mid-June when we last had this event. While July Indonesia thermal coal futures have also been consolidating around $90 US per metric ton. And on the agriculture side as well, crude palm oil prices have also declined recently. They were above 6,500 Malaysian ringgit a metric ton in the first week of June, and they've moved to below 5,000 ringgit per ton at present. So crude oil producers, CPO producers have also trimmed their year-to-date gains in recent weeks. So now we have Golden Agri Resources, First Resources, and Bumi Agri, which also rank among our top 100 stocks by turnover. Their average 17% return so far in the year-to-date, up, continuing the momentum from last year, which was up 31%, but albeit trimmed their gains by around 10 to 15% over the past couple of weeks. So we have seen some of those key futures prices of the commodity markets obviously recede some of their gains in recent weeks. Manufacturing as well, just to update, one key economic pillar obviously that spans multiple sectors is manufacturing. And on Friday, we saw our industrial production book 9% growth for the first 5 months of this year, follows the 13% growth we saw in 2021 and the 7% growth we saw in 2020. Now, resilient regional trade has also supported manufacturing industries. So our non-oil domestic exports, as you know, for the last 18 months, it's been expanding on a year-on-year basis. Our 20 most traded stocks with significant manufacturing activity, they generally span all those facets of industrial production. So we have electronics, precision engineering, we have chemicals, medical, transport engineering, as well as general manufacturing. So those 20 stocks, they have a combined daily turnover around 200 million Singapore dollars a day, and they've averaged a 4% decline in total return in the year to date, albeit the stocks that have been listed for the duration since the end of 2019 have averaged annualized total returns of around 13%. Now, the MIDI also have maintained that Singapore's electronics cluster is expected to expand more strongly than earlier projected, bolstered by robust global demand, obviously for the semiconductors, for the automated parts, the 5G, as well as the cloud services and the data centers. Electronics were also a key part of the May growth, okay? The semiconductor segment was up 46% year on year. So last week, what was interesting is we saw Franken Group, Nanofilm, ST Engineering, ISDN, UMS, Aztec, AEM, and Venture. They all averaged close to 2% total returns versus the STI's 0.4% return. And that we saw some global rotation into the technology sector last week. In fact, most of June, we've seen tech stocks move broadly in line with global stocks following the first 5 months of pretty significant underperformance. And also in the manufacturing realm of stocks, we also saw the medical side of our manufacturing related stocks post gains. Obviously, the BA4 and the BA5 variants continue to be closely monitored. What we've seen is average global daily cases last week cross above the 600,000 threshold. I think it was at 675,000 yesterday. And that's up from a low of 465,000 at the end of May. So that's what's kind of been moving a lot, markets on the move, if you will, in the last week. And I'd like to just quickly introduce our REIT market, or reintroduce our REIT market. As you know, we're fast approaching our 20th anniversary of listing our first REIT, which was on the 17th of July. So since then, we've obviously grown to be one of Asia's largest REIT and property trust markets. Our combined market value of the sector stands at something like 110 billion Sing dollars. So it represents 12%. Our total S-REIT sector represents 12% of our total market value of all stocks listed on the exchange, but it basically doubles its impact in terms of the day-to-day turnover. So it accounts for something like 20 to 25% of the day-to-day turnover of all our stocks on the SGX. The trusts are also highly diversified across property types, a very strong balance across retail, industrial, office, and hospitality properties, in addition to multiple REITs covering healthcare-related properties, as well as specialised REITs such as data centres. And as many as 18 of the trusts exclusively invests in property assets outside of Singapore, with 19 of the trusts investing in properties both in Singapore and outside of Singapore. And the remaining 4 REITs, I should say, just purely now investing in Singapore. So within Asia, it includes as many as 10 trusts with properties in China, 8 REITs with properties in Japan, 6 REITs with properties in Malaysia. And despite this overall backdrop of increasing rates, the sector averages a dividend yield of around 6.4%, which is still offering a high yield spread of something like 300 basis point premium to Singapore government 10-year bonds. And furthermore, the sector does appear to have controlled debt levels with an average gearing ratio of around 37%, which is lower than the regulatory limit of 50%. And the sector has on average also secured 75% of their borrowing on fixed rates. Now, data center and industrial REITs really outpaced, you might recall, back in 2020 and 2021. And again, that was on the demand for some of those factors we talked about before, like cloud services, and also supported by resilient manufacturing activity. But Singapore's Hospitality Staples Trust were among the strongest segments of the S-REIT sector into June this year, with the reopening momentum really driving those hospitality type of REITs, not just in Singapore, but across Asia. Importantly too, as we said, we have this international exposure. We have as many as 6 US-focused S-REIT and property trusts listed for trading on SGX, with stapled RAUS, with the stapled RAUS Hospitality Trust investing in hospitality properties, and the 4 REITs, Keppel Pacific Oak US REIT, Manulife US REIT, Prime US REIT, and of course United Hampshire US REIT investing in office properties. And we have Digital Core REIT now investing in data centers. And together, these 6 trusts have averaged something like 11% decline so far in the year to date, but that has actually been a lot more defensive than the FTSE EPRA REITs index, which I think has declined around the 16 to 17% mark so far this year. And of course, the 2 most defensive of those 6 REITs that have all their assets in the US, the other 3 have partial assets in the US. The 2 most defensive of those 6 have been so far this year RAUS Hospitality Trust and United Hampshire US REIT. So I think it'd be a great time for me to stop talking about the stock market, Robert, and have you on to because you are the main guest tonight, and I think the investors would love to hear more about this United Hampshire US REIT. Thank you. Thanks, Eileen. Thanks.
So should I take it away from here, Jeff?
Yep. So up next, may I invite the senior management from United Hampshire US REIT, Mr. Robert and Mr. Gerard, to take over, please.
Great. Thanks, Joyce. And thanks, Jeff. Thanks for having us on the Corporate Connect webinar. And it might have been a little slip, but I think Jeff referred to us as an office REIT. We are defensive. We are not an office REIT, however. I think he knows that. He just made a little slip there. But yeah, we are Asia's first US grocery anchored shopping center and self-storage REIT. When we launched in March of 2020, it's been a whirlwind of 2 years. We're still here. We're still the only Asia's only grocery anchored REIT still. And we're very pleased with the resiliency the portfolio has shown throughout the pandemic years. And now as we face a whole new set of macroeconomic challenges, inflation, rising interest rates, the war in Ukraine, supply chain constraints, we do feel we're poised to continue to demonstrate that resiliency as we move forward and face these next challenges. If you look at this first introductory page here, we're maintaining a long WALE. We're the longest in the REIT universe, been able to maintain a very high occupancy. Right now we're at 96.4%, which is the highest since the IPO. Very minimal amount of leases expiring in 2022. And these are necessity-based tenants providing everyday needs of the US consumer. Very resilient because regardless of whether the economy is up or down, people are going to need to put food on the table. And we have a lot of grocery stores. We have a lot of home improvement stores. We have a lot of necessity-based tenants of goods and services that the consumer needs on a day-to-day basis. So very pleased where we're situated and look forward to continued resiliency as we move forward. Real quickly, many may already know this, but we are East Coast focused. Couple reasons for that. Number one, we're based in New Jersey. We know these markets. We're very familiar with them. But in the East Coast, 40% of the U.S. consumer is located, and with grocery anchored retail and self-storage, this is a consumer-driven sectors. We deal directly with the U.S. consumer. That accounts for 2/3 of the U.S. economy, and this is where the consumer lives. We have a balance of assets in the Northeast. It's the much more mature part of the country with higher buying power, less developable land available for new development, combined with the Southeast, North Carolina and Florida, which are much more higher growth. Florida is one of the most high growth states in the US. So kind of combining that balance of secure infill, high buying power in the Northeast with the higher growth elements of the Southeast, we feel like it's a good blend, a very attractive proposition for investors. If you look at the next slide, just a brief snapshot. These are the first Q results. From 2022, we obviously don't have our second Q results out yet, but did very well across the board in terms of gross revenue, up 20% from 1Q21. Net property income up 13% from 1Q 2021, and then distributable income 7.9% up from 2021. Some of that certainly attributable to our 2 large acquisitions we made in the third Q of last year with the Penrose Shopping Center in Philly and the Colonial Heights Shopping Center in Richmond, but we also achieved some significant leasing and leasing renewal as well to help drive these favorable results in the first Q of 2022. Looking at our balance sheet, very conservative gearing, 38.9%. Very attractive interest rate, 2.89%. Just about 80% of that is fixed rate debt. We have a $15 million tranche that does float with SOFR. As you can see here, we kind of mapped out the impact of rising interest rates. Every 50 basis points in change in the SOFR translates to a 0.051 change in the DPU. We are tracking that. We do have a portion of that debt that comes up in 23. We're actively working with our lenders now to talk about recapitalizing and refinancing that debt. We also have uncommitted RCF facility of $14 million. So overall, the balance sheet is in very good shape and in a conservative position despite the rising interest rate environment we're facing. Going on to the next slide. I mentioned how well we've been doing with leasing our portfolio. Again, 96.4% occupied right now, highest in the last 2 years since we launched the IPO. Very minimal lease exposure rollover in 2022. A lot of that's because we got ahead of that. In 2022, we did about 370,000 square foot of renewals last year to reduce the exposure down from 9 to 1.3. And we're off to a great start in 2022 as well. 5 new leases and 5 new renewals, 1 shopping center. We did a large lease to improve the vacancy from the occupancy from 68% to 93.4%. And now we have the Fairhaven Plaza. We've done some leasing there as well. And that property is now 100% leased for the first time since the IPO, despite going through the pandemic and all the challenges that the pandemic brought with it. So we're very pleased with the way the portfolio has been able to remain leased and attract new tenants throughout the course of the duration since the IPO. Moving on to the next slide, we've talked a lot about this over the last 2 years. Omnichannel continues to be the key to success for our tenants as well as the tenants across the board in retail. And again, omni-channeling, a very key philosophy that basically means that these tenants providing multiple means of shopping options, both digital and physical, for the U.S. consumer to meet their preferences and lifestyles. You have to be flexible as a retailer. You have to provide optionality. Some people like to buy online, pick up in store. Some people like to shop physically. Some people like to get their groceries and their products delivered. The successful retailers has to be able to do all of this. And that's what we're seeing right now. The evolution of the physical store is on the way back. For a while there, it seemed like the sky was falling and all retail was going to be done via e-commerce. That's not the case. Physical stores have made a significant comeback, and now we're seeing much more of a balance between physical stores and e-commerce. In fact, the growth in retail sales from physical stores, you can see here, has outpaced that for e-commerce over the past 4 quarters. We're seeing digitally native companies come out now with new physical stores like Allbirds, Warby Parker, Casper. Micro-fulfillment is becoming very strong, which basically means the fulfillment of online orders is done in the bricks and mortar stores. And the reason for that is pretty simple. These stores are located close to the rooftops where people live. So it's very convenience oriented and makes it easier for people to shop. You're looking at companies like Walmart, Target, all opening micro-fulfillment stations in physical stores that already exist. So that's how they continue to drive their revenues and their profits. Going on to the next slide. This is a graphical depiction of what's going on. I mentioned earlier how e-commerce has slowed down and the growth in bricks and mortar has accelerated over the past few quarters. And you can see here, if you look at the first quarter of 2022, bricks and mortar growth is significantly higher than that for e-commerce. Now, we don't know. I don't have a crystal ball. I don't know if this trend is going to continue. E-commerce may start to accelerate again. We just don't know. But again, the key takeaway from this is the good retailers need to be able to provide optionality for the U.S. consumer, be it digital or bricks and mortar. They have to be ready for the growth, no matter what direction it goes. And those are the types of tenants we're focused on in the UH REIT portfolio. We've also talked a lot about essential services and uses. 68% of our tenants are essential uses. And again, you know, with inflation as high as it is, this provides us with another means of resiliency, because when the inflation rises, consumers are going to figure out how to buy the essentials. What they're going to cut down on is the non-essentials, such as clothing, luxury goods, travel, but they're still going to get to the grocery store. They're still going to put food on the table. They're still going to buy food and services for their homes. They're still going to buy medical. And these are the types of tenants that comprise the UH REIT portfolio. If you look at our top 10 tenants, 95% of our top 10 tenants are considered essential services. We're very comfortable with the way our portfolio and our uses line up with respect to essential uses. Looking at our major retailers, certainly inflation has had an impact over the past few months on their performance. These are the first Q results. However, the sales for the most part have been very strong. Lowe's was down slightly. Earnings for Walmart taken a little bit of a hit because of higher inventory and staffing costs. But overall, these retailers continue to perform well, and they're still performing at levels above at which they were pre-pandemic. Again, we have to keep an eye on inflation. There's a lot of volatility right now, but we have the right tenants to be able to weather the storm and work their way through this inflationary environment that we're experiencing right now. Shifting over to self-storage, fundamentals are still very strong. We've talked a lot about this over the last couple of years. The demand drivers for self-storage really driven by major life events, death, downsizing, and dislocation. Through the pandemic, a new demand driver evolved, and that was this word decluttering, with the work-at-home business models that companies are now offering. Consumers were creating more efficiencies in their own house for offices and workout areas, and just to create more room, because they've been spending more time in their houses. And as the pandemic, we move out of the pandemic into the post-pandemic phase, you know, a lot of these work-at-home policies are to continue to stay in place, because employers are worried about losing their employees if they enforce restricted return home policies. So we're still seeing a lot of flexible work-at-home environments. We continue to believe that that's going to be a sticky policy going forward in the U.S. corporate environment. So all these trends are benefiting the self-storage demand, and we're seeing the fruits of that on our own portfolio. If you go to the next slide, Charlene. Carteret and Millburn performing very well. We're up to almost 95% on our Carteret facility. Millburn close to 98%. And the rental growth for existing customers, double digits for 2021 and into 22. We've also done well with Elizabeth and Perth. If you go to the next slide, most of you do know by now, we made the announcement that we did take advantage of really an opportunistic situation with the self-storage, where capital values were basically appreciating quicker than the value of the cash flows. These two facilities were perfect examples of that. The budgeted cash flow for 2022, even though rates have been on the rise and occupancies have been up, we were basically somewhere at 2.5% cash on cash return. because capital values were so high. We took advantage of an opportunity to sell at a price of 45.5 million. So now we're basically harvesting that capital that was dedicated to these self-storage facilities, achieving, say, a 2.5% to 3% return. And now we're reinvesting that into a much higher yielding grocery retail property that we're showing here on the next page at a cap rate of 6.5%. So this is very accretive to DPU. It's very accretive to net property income. And we're very excited about this opportunity to take the portfolio value up from 680.5 to $730 million. This property called the Upland Square Shopping Center. It's another property in Pennsylvania. It's in a different submarket than the Penrose property we bought in November. This is northwest of Philadelphia, about 45 minutes. It's really a regional draw, 400,000 square feet, anchored by the most dominant grocer in Western Pennsylvania called Giant, owned by Ahold Delhaize, a strong performer. It's also got some great, fabulous complementary tenants on the off-price clothing side, Burlington, TJ Maxx. Great barriers to entry here, very visible. It's really the best shopping center in the region, and it draws from over 10 to 15 miles in every direction. And the whale is very strong. It's a committed occupancy of 100%. We look forward to adding this to portfolio. The closing date is targeted for the end of the month, the end of July. So again, very pleased with this acquisition and be able to recycle that capital into a higher yielding asset. In terms of the economic outlook, I'm sure you all have read a lot about it. We know we're dealing with a lot of uncertainty right now in terms of rising inflation, interest rates. Again, the supply chain issues continue, but at the end of the day, the GDP forecast in the U.S. for 2022 remain on a positive note because consumption remains fairly strong. Consumer sentiment is down, but the consumer is still out there buying retail. And the reason for that is because the labor markets are so tight. Again, 3.6% unemployment. There's still almost 2 to 1 job openings for every person looking for a job. Wage gains have continued to be fairly strong, although maybe not keeping up with inflation. The consumer remains relatively healthy. He's got some savings, and he's out there spending on at least necessity retail. So again, we don't know what the future is going to hold. Obviously, there is recession concerns, there's inflation concerns. We're keeping an eye on that. But again, our portfolio relative to other retail is well situated because essential goods and services, food, home improvement, medical, the type of things that the consumer is going to need regardless of the state of the economy. So we feel like we're well situated despite some of the uncertainty that is facing the U.S. economy going forward. In terms of retail sales, in May, up 8.1% year over year, so still strong. Now, they were down slightly from April, from the preceding month, 0.3%. Consumer sentiment is down right now because of the macroeconomic conditions facing the consumer. But again, saving rates are hanging in there. Consumers are still out there buying. As you can see here, consumer spending rose at a 2.7% annual rate in the first Q. Now, there's a lot of sectors that are still doing well. Retail-wise, home improvement marks one of them. A wholesale club, they're doing tremendously. The U.S. consumer is still buying appliances, sporting goods, things like that. So while sentiment is down, they're still purchasing things, and we need to track it. We know there's uncertainty, but we feel like, again, we're in a good place. If you look at the necessity retail sector, We talked earlier a little bit about earnings for certain retailers taking a hit because of inventory, but sales are still strong. Discounters, food and beverage, home improvement still doing very well. 2022, the estimates are more store openings than closings. Foot traffic is back, very strong. And again, I can't underemphasize, not only in our portfolio, but the sector as a whole, leasing activity has been robust. Off-price clothing, we're looking to open a lot more stores, discount dollar stores, grocery stores such as Aldi. There's a lot of retailers who want to open new stores in locations throughout the U.S. Occupancies have been very strong. And then the amount of leasing for the first Q of 2022 is basically the same, on a par with what the leasing levels were pre-pandemic. Foot traffic for all retail types, power, community, lifestyle, neighborhood are up. And then I mentioned the occupancy up around 92% for the sector. BUH REIT's portfolio, again, 96.4%. Briefly, self-storage, fundamentals again, maintaining very strong with a 94% overall occupancy across the sector. In-place rents 9% higher in 2Q 21 versus 3Q 21. Cap rates very strong, as I said, that led us to do the opportunistic sale of the 2 development deals. There are signs that interest rates are going to have an impact on cap rates going forward, both on the retail and the self-storage side. But so far on the grocery anchored side, the cap rates have held up. Self-storage slipped slightly, but still very strong. We look forward to continued resiliency in both sectors moving forward. Real briefly on the asset management highlights, we're focused on leasing and a couple major asset enhancement initiatives. Most of you know, I believe, about the Port St. Lucie expansion that was completed in March. The new Publix is open, performing well. We now have backfilled the majority of the old Publix space. We have an LOI for the remaining balance of it. I talked about Town Crossing now being up to 93% in Fairhaven. And then we continue to support the tenants in their omni-channel efforts. There's been a big asset management push with respect to omni-channel and curbside pickup, dedicated lanes, delivery as well, coordinating that with our tenants also, and then micro fulfillment, finding stores and locations for our tenants to fulfill these orders from e-commerce on site to create these efficiencies we discussed earlier. And then lastly, we have implemented the first phase of our sustainability strategy in terms of governance, environmental stewardship, and community engagement. Very proud of some of the recognition we got on our governance. Ranked 4th in the Governance Index for Trust, the GIFT 2021, 4th out of 45 publicly traded companies. And then we were one of 95 companies that received the SGX Fast Track for our compliance track record. Focused on the sustainability side, adding a lot of EV stations to our properties, and then we're working on controlling our Scope 1 emissions by improving our LED lighting program. We're also working with our tenants in terms of collaborating on ideas to improve their own Scope 2 and Scope 3 emissions. One of the things that's a little challenging with open air centers is most of the tenants are under triple net leases and they control their own spaces. So we as the landlord don't necessarily have direct control over the interior of their spaces and the efficiency carbon emissions inside those spaces. But We've developed a lease rider. We're working with these tenants to come up with initiatives to help improve those emissions in their own spaces. And we're also working on community outreach and social outreach programs, both inside the company and throughout, working with Habitat for Humanity in the US. I know the Singapore team has done some volunteer work and some outreach as well in Singapore. So we continue to build our sustainability program, and we're going to have a much broader approach as we move forward. We know we're just at the tip of the iceberg with this, but we are focused on it. The board is focused on it. We look forward to developing a more comprehensive program moving forward. So with that, I probably talked too long. Recapping real briefly, what we're all about is stable cash flows, cycle agnostic assets with long WALE, stability, income stability over time with growth. There is rent steps in the retail leases, and on the self-storage, we can drive rents even more frequently than yearly because we do have month-to-month leases there. East Coast focused, and again, e-commerce resistant, strong, best-in-class tenants with a resilient omni-channel platform. So this is our value proposition, and because of this, we feel we are very resilient, and wherever the economy takes us from here, we're ready for it. So I will close it down at that and open it up for Q&A anyone may have.
Thank you, Mr. Robert, for the presentation. We have now come to the Q&A session. May I also invite Mr. Gerard Yuan, Chief Financial Officer, United Hampshire US REIT, Mr. Derek Gardella, Head of Investments, the Hampshire Companies, as well as Mr. Benjamin Goh, Head of Research and Investor Education from SIAS, to moderate the Q&A session. Participants, you may input your questions in the Q&A section here, and for our Facebook audience, please click on the link in the description box to join. We will try to answer as many questions as possible. Over to you, Benjamin.
Thank you very much, Joyce. Evening, gentlemen, or should I say good morning where you guys are at. I believe you guys are in New Jersey.
That's correct.
All right.
In Singapore, we've got half our team in Singapore and half over here in New Jersey.
Ah, okay. So while the team in Singapore enjoys sunny Singapore, getting baked in the sun, sometimes you guys are going to be, pretty cool out there?
That is true.
Okay. All right. Very appreciative that you guys are able to join us. Certainly, the US retail space is, something that's very interesting to Singapore investors. And, based on the newspaper reports, similar to in the US, Singapore, shoppers have gone on a, shopping spree, revenge shopping, since everybody is let out of their cages, no more COVID, social distancing and restrictions. So yeah, we're out dining and there's no tomorrow. So it's good to see that your numbers are up as well. We do have a couple of questions. They were pre-submitted, and I'm just gonna curate those. Some of them are more or less similar, and we do also have got some of the questions that have just come in. So without much further ado, let's just get started. I beg your pardon. All right, the first question is about the share price. The activity has not been as high as expected, and I suppose some of the retail investors here in Singapore would like the management to provide some color as to what's been happening with the stock appreciation as well as the dividend policy.
So yeah, in terms of the stock, I mentioned we know that UH REIT is Asia's first grocery anchored property REIT. We feel like it may not be a sector that the Asian investor is familiar with. So we've been spending a lot of time doing some investor outreach, participating in presentations like this to kind of get the word out on, how a necessity-based grocery anchored shopping center differs from a typical, say, regional mall that you may see in Singapore. It's highly different. It's in the communities where people live and work. it's necessity goods and services. And I feel like there's an education process that is taking a while longer than we had hoped. But that said, things are coming around. If you look at the average daily volume for last year, we were somewhere around 294,000 daily. So far this year, we're up to 443,000 daily, an upswing of 51%. So, we do believe that we continue to get the word out and continue to perform and push out our distributions as promised, that the word will get out and we'll see the trading volumes go up. So we're going to be optimistic there.
Okay. Well, the overall U.S. stock market certainly has not been doing anybody any favors. Would you say that part of the performance of United Hampshire is also due to the overall market correction and fears about recession?
Absolutely. The volatility in the U.S. markets, as you point out, has been very drastic. And a lot of companies are experiencing significant discounts now relative to their NAV. And if you really drill down into the numbers, our discount that we're seeing right now is probably not too far off from some of our competitors. I'm not going to talk about our competitors, but we're definitely kind of bucketed with not only the U.S. stocks, but the U.S. REITs are in the same type of sector, and they're experiencing a similar discounting.
Sure, and I suppose that the retail space they are in is certainly very much better compared to very lofty targets, embedded in the valuations of companies like Meta as well as Google. Certainly those stocks have not been doing really well, actually. Okay. Well, moving on to the dividend policy, there was a question about whether or not there's a dividend policy, and would you be able to provide some guidance as to the frequency as well as the expected distribution per unit going forward?
I'm not going to comment on the amount of the DPU going forward, but in terms of the frequency, we do make semi-annual distributions that are distributed out in March and September. The total DPU that we paid out since inception is 10.91 US cents, 4.81 last year for the partial year, and 6.10 for 2021 full year. In the near term, that's the policy we expect to continue, semi-annual distributions going forward.
Okay. Certainly REITs a viable investment vehicle, especially for Singapore investors looking for dividend plays. So certainly United Hampshire has delivered on that promise very well. Moving on to a different topic. In your presentation just now, you're talking about some of the key highlights as well as what you see going forward, the overall U.S. economy as well as United Hampshire. Perhaps you could provide a little bit more color regarding the growth plans that you may have in the next 2 to 3 years.
Sure. The growth plan obviously is to continue to focus on the two sectors that we've targeted to date, the necessity-based retail and the self-storage. Now, where we're at right now, I mentioned in my presentation that capital values for self-storage have really accelerated significantly more than the valuations for the cash flow. So that's kind of a long-winded way of saying cap rates for self-storage are very aggressive right now, even though they may have slipped slightly because of the rising in interest rates. But I think it'd be very difficult right now to acquire self-storage assets that are accretive to DPU. So at least in the near term, we're still very bullish on the self-storage sector itself. We're going to continue to look at the market because it changes rapidly and frequently. But for now, we're focused on building more the portfolio through necessity-based retail, where cap rates, we're anywhere from 6 to 7. Overall, retail cap rates are rising somewhat over the past couple months because of higher interest rates, but so far, grocery anchored stuff is holding pretty strong. It was the most traded retail sector over the last quarter, not surprisingly, because grocery anchored has held up so well over the pandemic. But we are in the markets frequently looking for assets that meet our criteria and that I've talked about a lot: best in class tenants, infill locations, high barriers to entry. We're in the markets every day, and we do believe that there's going to be opportunities forthcoming that meet our criteria that we can purchase maybe in that 6.5 to 7 cap range. Again, as interest rates rise, expect there'll be some lag, but ultimately cap rates will rise too, and we still think there might be accretive opportunities going forward to do that.
Self-storage is a bit of an interesting segment for people living in Singapore because we don't really understand what that is. We keep all our junk in the bomb shelter that we have in the apartment. So we don't lease a place just to keep our crap. No, we don't. But certainly it is a I guess very common, ubiquitous product service that people use in the US. I've many years ago I went driving actually in the US all the way from the east side to the west side. Yeah, and I went to a lot of this I guess factory outlets as well as malls dotting the USA. Yeah, it's pretty fun. Yeah.
The self-storage sector is very interesting because you refer to the junk. I mean, U.S. citizens store their junk in self-storage over here too. And the good news about self-storage is once they get their junk in these facilities, they just kind of leave it there. The rents are relatively low considering other expenses. So you just debit the credit card, and over the pandemic, we're finding that the average stays for self-storage have actually risen. People are keeping their junk in there even longer. And they've kind of evolved to more of a kind of a more industrial park type locations to retail locations with better facades, cleaner looking, more retail orientation. So there is more, I would say there's more alignment with traditional retail properties now with self-storage as well, which is one of the reasons that we kind of merge those two sectors together. There's a lot of retail components to self-storage now in the US.
And I suppose for people who use these facilities, it's I'm guessing cheaper than keeping it at home, where if you're renting your place, it could be actually more expensive just to keep an old bicycle or your sports equipment.
It is cheap, and you can store a lot of stuff in it. I mean, it's 100 square foot space, $100 to $150 a month, which is pretty reasonable. And you don't have to worry about it. You create all this extra room in your own house, and you don't have to deal with the junk anymore. So yeah, it works out well for the U.S. consumer.
All right. Okay. We do have a couple of questions that came in. One is about the proposed acquisition of Upland. There was a section 6.1 regarding pro forma DPU. Let me see. The number of units decreased after the divestment as compared to before the divestment acquisition. Would you be able to comment on why there was a decrease in the units?
Remember, you want to handle that one?
Sure. Thanks so much for the question. Yeah, so the way we run the pro forma is we create the pro forma as though we had sold the self-storage assets right at the start of the year, as of 1st of January 2021. And our management fee, meaning the fee that the REIT manager receives, is actually a percentage of the distributable income for the year. So while the question is correct from in terms of, yes, more units were issued for divestment fees, on the other hand, because we had in the pro forma we had sold these two properties, the distributable income was lower because there's no longer the contribution from these two properties, and hence the management fee that the REIT manager would have received. And for the FY 2021, we elected to receive all our fees in the form of units. So because there's lower management fees, there were much less units issued as well, which is why in the pro forma that you're referring to, you'll see that both the distributable income is lower as well as the number of units are lower as well.
Okay, so sounds like in layman's terms, it's a bit of a timing issue as well as a difference in the way you actually reported the numbers as opposed to the pro forma numbers.
I mean, what I would say is that the pro forma is assuming we had sold off the two properties. So in short, if you don't own the properties, there's much less distributable income from the REIT, and so the REIT manager receives less fees. That explains why there were we didn't issue as many units as payment of the REIT manager fees.
Sure. All right. We do have a different question, is about the timing of the dividend payout. So the question is, if an investor were to buy the United Hampshire REIT share tomorrow, when would he or she be able to expect the dividend payout?
We're going to close out. We pay every 6 months, semi-annually. So we're reaching the end of our first half of 2022. So the payment of the next dividend, we will announce the results typically around August. There'll be a book closure date thereafter, and you will receive payment typically by September. So the short answer is in September, you receive your dividends for first half of the year.
Okay, thanks for that. All right, there is a different question. This is regarding the one of the big risk factors associated with REITs. That is the refinancing of the debt load. In your presentation deck, there was a slide that showed that the bulk or the majority of your debt needed to be refinanced in 2023 as well as 2024. And you had commented that you have already commenced negotiations or discussions with your financiers. Would you be able to provide a little bit of color regarding that? You know, because the timing is might be, I guess, a little bit of a concern, since heading into 2023 and 2024, we might be right smack in the middle of a, I don't know, slowdown in economic activity.
Yeah, we have 97.5 million expiring in 2023. We are working with lenders to secure proposals to try to refinance that. I mean, obviously, interest rates are on the rise. We all know that. You know, it is likely that we're going to be experiencing some increase in debt service as we move forward. But you know, overall, we're finding the lending markets receptive to proposals to extend out. So, you know, we are confident we'll ultimately end up in a good place with that. And as I said, 80% of it is fixed right now. So we won't feel really any significant impact of that, you know, until we actually complete the refinancing. And we don't know where the interest rates are going to end up. You know, knock on wood, hopefully things will start to slow down a little bit in terms of rate increases, but it's tough to predict where we're going to end up. But all I can say is the lenders are receptive. The markets like what we bring to the table. You know, what's nice about UH REIT, as I mentioned it before, the WALE is very long. You have a lot of long-term anchor leases with strong credit. So the lenders look on that as very favorable. And we think at the end of the day, we are going to get very favorable terms relative to market conditions to be able to recap that debt that matures next March.
Okay, we do have a final question, which is related to the previous question about the dividend payout, the timing of the dividend payout. So the question here is quite specific. When is the cum dividend date as well as the ex-dividend date? I suppose this one will be one for Gerard.
That's the Gerard, yeah.
Sure. We haven't announced the actual date yet, but we have to release our first half results by middle of August. And then typically the book closure date will be a few days thereafter. So to give you an example, last year, I think book closure date was on the 20th of August. So although we don't have the exact dates for this year, it will be around that period of time. I think if you make your acquisition before that date, then you will be entitled to the distribution that we paid in September. And that will be for the full 6 months of this year.
Okay. All right. Thank you, gentlemen. We have no more questions and as well as no more time, but very appreciative that you're able to join us, especially Robert as well as Derek, considering it's you guys are 12 hours behind. So thank you very much for speaking to our retail investors here in sunny Singapore, as well as Gerard. Thanks for the answers to all the technical financial questions. So with that, we are going to close the Q&A session. Over to you, Joyce.
Thank you, Ben. And thank you to all the panelists for an insightful sharing session. We have now come to the end of the session. Thank you everyone for joining us this evening. In case you missed any part of today's session, you can rewatch the webinar on SIA's YouTube channel. Corporate Connect is a bi-monthly webinar. Do visit our website to get updates on our upcoming investor education programs and initiatives. The upcoming Corporate Connect will be featuring HRNet Group on 5th of July. Thank you and have a good evening.
Thank you.
Have a great day, gentlemen.
Thank you.